Welcome back. Today, we are pulling back the curtain on a layer of crypto data that most retail investors honestly just completely ignore. We're going to show you how to see what the smart money is actually doing, not just what the price chart tells you. Okay, let's get into it.
So, just ask yourself this. When you look at a crypto chart, are you really, truly seeing the full picture? Because relying only on price, well, it's kind of like trying to understand a book just by looking at its cover. You see the outcome, sure, but you have no idea what's actually driving the story inside. And yeah, this lie, it just lays it out perfectly. Price is the effect. It's what already happened. On-chain data, though, that's the cause. It shows you why it happened. This completely flips the script. You go from just reacting to what's already done to analyzing what could happen next. You're not just a passenger anymore, you're the one reading the map. You know, the craziest part is that this so-called hidden layer isn't really hidden at all. Every single transaction on a public blockchain, think Bitcoin, Ethereum, it's all recorded, it's all public, and it's permanent. It's right there in the open, but it's a stream of data that most people just don't know how to read. And this is exactly why it matters so much. Price charts can be super noisy, they can even be deceptive. You've got stuff like wash trading to fake volume or spoofing to mess with the order books, but the blockchain itself, it's immutable. When a wallet moves 10,000 Bitcoin, that is a verifiable, permanent fact. It is the ground truth. No debate. And that brings us to the big idea for today. The best way to think about on-chain analytics is that it's like having a kind of X-ray vision. Instead of just seeing the surface, the price, you get to see the bones, the actual structure of the market, and the behavior that's shaping everything. I mean, this quote just says it all, doesn't it? Price shows you the past. On-chain data is all about understanding what's happening right now to get a way better sense of what's coming. It's about anticipating, not just reacting. So let's just put a clear definition on this thing. On-chain analytics is simply the practice of reading and interpreting the raw data straight from the blockchain. We're looking at who's sending what to where, what wallets are doing, all to understand the health of the network and what people are actually thinking and doing. All right, so now that we know what it is, let's get practical. Let's make this useful. We're going to walk you through 4 of the most powerful and honestly pretty accessible on-chain signals. These are the core metrics you can start using literally today to get a much clearer picture of what's going on. First up, let's start with one of the most straightforward and important signals out there, exchange flows. This is super simple. It just tracks the amount of a crypto, like Bitcoin, being moved onto and off of the centralized exchanges where everybody buys and sells. And the logic here, it's super simple but really powerful. When tons of coins flow into exchanges, it's generally a bearish signal. I mean, why else do you move coins to an exchange? Usually it's to sell them. But on the flip side, when coins are flowing out of exchanges, that's bullish. It tells you people are planning to hold for the long term, moving their coins into their own secure wallets. And when you zoom out and look at the long-term picture, you see this incredibly powerful trend. This chart shows the total amount of Bitcoin sitting on exchanges over the last few years. See that? That clear, steady downtrend is a fundamentally bullish backdrop. It means there's less and less liquid supply just waiting to be sold, which creates the potential for a massive supply squeeze if demand suddenly picks up. Okay, signal number 2 is one that everybody loves to talk about, whale tracking. This is all about monitoring the wallets of the biggest players in the game. And since every transaction is public, you can literally watch what they're doing in real time. It's pretty wild. And what they do is so telling. When you see these huge wallets consistently buying and accumulating at certain price levels, it's a huge signal that the smart money thinks an asset is undervalued. And when those same wallets start selling or distributing after a big price run-up, well, that's often your first warning that a market top might be getting close. All right, our third signal sounds really technical, but I promise it's actually super intuitive. It's called the MVRV ratio. Now, that stands for market value to realized value. But all you really need to know is that it helps us see if the current price is fair, overheated, or undervalued by comparing today's price to what everyone, on average, paid for their coins. So the key is just knowing the important levels. The best way to think of MVRV is like a fever chart for the market. When that ratio drops below 1.0, it's historically been a sign of deep fear and a major undervalued zone, often an incredible buying opportunity. Why? Because it literally means the average holder is now officially underwater on their investment. But a ratio above 3.0, that suggests the market is euphoric, totally overheated, and it might be a smart time to think about taking some profits. And for our final key signal, we're looking at stablecoin supply. Specifically, we're watching the amount of stablecoins like Tether and USDC that are just sitting on exchanges. The absolute best way to think about this is as dry powder. It's cash parked on the sidelines, ready to be fired into the market. So it's pretty clear, right? When you see the supply of stablecoins on exchanges going up, that's a bullish sign. It means more and more capital is getting ready to buy. It's fuel for the next leg up. But when that supply starts to fall, it means that buying power is either being spent, which pushes prices higher, or it's leaving the ecosystem entirely. Okay, so this is all really great information, but it's totally useless if you can't actually access it, right? Well, the best part about all of this is that you don't need to be some hedge fund manager. A lot of the best on-chain tools are accessible to every single one of us right now for free. Here are a few of the big ones, the industry standards. If you're just starting out, I would strongly recommend 2 of them. Go create a free account on Glassnode, and then bookmark the website Look Into Bitcoin. Both of them have incredible charts covering everything we've talked about today, and they are fantastic for just learning the ropes. So, how do you actually use all this stuff to make better decisions? Look, the real power of on-chain data isn't in looking at one single metric by itself. It's about combining them, layering them together to build a complete picture, a high-conviction thesis. Here is a super simple checklist you can use. First, check the exchange flows. Are coins leaving exchanges in a big way? Okay, that's bullish. Second, check the MVRV ratio. Is it in an undervalued zone? Also bullish. And third, and this is the most important part, look for confluence. If you have whales buying, coins flying off exchanges, and a low MVRV, well, now you've got multiple independent signals all screaming the same thing. That's a powerful insight. And that really is the key takeaway here. On-chain analytics is a total mindset shift. It's about moving beyond just staring at a price chart and starting to read the actual verifiable human behavior that is driving that price in the first place. This is the edge that most people are missing. We really hope this gives you a whole new lens to view the market through. Make sure you join us for our next explainer, where we'll be diving deep into crypto narratives and how to spot the stories that drive these massive trends, stuff like AI coins or real-world assets, before they hit the mainstream. You are not going to want to miss that one.